Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. Our guest today is Neelkanth Mishra, and you can't find too many people who are better at putting growth versus valuation into perspective, both on the macro as well as on the markets front. Neelkanth, thanks so much for joining in. Really good of you to join in. Could you tell us, how do you see the landscape from your perspective? Is it worrisome, the growth worries, or are we maybe looking at a glass half empty and we need to look at a glass half full?
No, so there is a growth concern. Most high-frequency indicators have slowed. We've seen a sharp pickup in earnings cuts. Initially, these cuts were only in FY25. In the last couple of weeks, we have seen FY26 earnings start getting cut as well. So investors and analysts are starting to get worried. The indicators that we track, there's not yet a very strong sign of recovery, but I think there is enough for us to be slightly optimistic. Our view is that this slowdown is cyclical, and that incrementally now momentum indicators should be improving. Whether we get back to the growth trajectory that we had, the growth rate that we had in Jan-Feb of this year, is something that is less sure right now, but let's see how the economy revives. I will just add an additional point over and above the government spending. I think it is also about the monetary side of things. I know the MPC's hands are tied because of headline inflation, but on the quantity side, I think some of the other measures taken, that has also contributed to some of the slowdown. But those measures are also easing. So starting July, overnight liquidity was in surplus. In the last couple of fortnights, we have seen that is now starting to drive up deposit growth. So as you know, deposits are a macro variable, and they are starting to improve. So with both fiscal and monetary, the unintended tightening that happened starting to ease, it is reasonable to expect that by Jan-Feb, some of the high-frequency indicators will start improving as well.
Okay, Neelkanth, what does? I'm starting with the valuation question first before I get to other things. So, even if there is a recovery, I hope I can put this question across correctly. But even if there is a recovery, would the damage to earnings done thus far, and possibly in Q3 maybe, would that mean multiples come off a little bit? Or do you reckon the feeling of a recovery, because the market would tend to discount 6 months earlier, would that telltale signs of a recovery help the market sustain valuations and therefore the levels? Because we are maybe 8-9% off from all-time highs, if that is worth anything. But at 24,000, we are still about 20 times earnings, or maybe slightly more expensive if we bake in the earnings cuts.
Right. So let's put it on two different things, or basically two different variables. The first is what is global price to earnings, and second is what is India's premium to that. So let's start with the global price to earnings. Now, global price to earnings now are likely to possibly come under pressure because of all the macroeconomic uncertainty. So, for example, if the Trump policies were to get implemented, you will see that the fiscal deficit over the next 10 years, or let's say the debt over the next 10 years, cumulative deficit over the next 10 years for the US could be higher by $7 to $8 billion. So that is what some of the estimates are suggesting. Now, given what this entails in terms of bond yields, because if this level of excessive borrowing happens, then bond yields will go up, and that itself could be a disciplining force for the US. It is quite possible that it goes up, say, by $3 to $4 trillion, not $7 to $8 trillion, but $3 to $4 trillion. And given that this itself, meaning that it's very unlikely that this will be ever be repaid back, the only way to adjust for that would be for inflation to go up, and that will mean maybe a 1% point rise in inflation expectations. If you look at the tariffs, now there are all kinds of estimates. There are some people who estimate that consumer price index will go up by 1.8% in the US. Others believe it would be 2.5%. Remember that a very large part of US consumption is services, which doesn't get affected directly. Now, but that itself over 10 years would mean 20 to 25 basis points of higher inflation expectations. Now, if this is the case and you have an increase in the term premium because you need to have much higher yields to attract new buyers for government bonds, the US cost of so that the higher for longer story in the US now gets very cemented. We will start getting clarity on this. So we have seen an inflation expectation increase in the US by about, say, 20, maybe 25, 30 basis points. But I don't think the markets are clear on where things will settle. By maybe February, March, once the new president and his team are in place, we will start to see some clarity. But I think uncertainty on the macroeconomic side will remain elevated. So this means that global price to earnings are likely to also not see a significant increase. Now, when we come to the Indian story, now India's premium had expanded to, in between for a while, 45, 50% of the world. It has over the last several months corrected. Now we are at about 15, 17%, which is, I think, a reasonable level of premium to have. Can this premium expand? If we see a growth acceleration, possibly, because what happens when growth estimates are being upgraded, which is what started in Jan 23 and lasted till about, I would say, April, May of this year, was that the economy was continuously surprising on the upside. When those surprises end, it is reasonable to expect that the P multiple or the premium then starts to come off, which is what it has done. As you start to see cuts happen, so now we are starting to see GDP estimates getting slashed by consensus, then the P premium starts to come off. And I think going forward, if the growth acceleration starts to reemerge by Jan-Feb, it is reasonable to expect that the P premium, from 15% could actually maybe go up to 20, 25%. I mean, I'm not a big believer in just linking tightly the economy and the markets, but those broad frameworks, I think, should still work. Remember also that the FII outflows, what we saw in October and they've continued in November, were nearly 2 times the pace at which the domestic inflows were happening. So when this level of outflow happens, obviously there will be a pressure on price to earnings. Now, the question to ask is, are FIIs done selling? From what we have seen in the data, a large part of this selling of India is actually EM level selling. And given that China's stimulus itself has not been that exciting, and higher US rates generally means a stronger dollar, which is actually generally not so good for emerging markets. So I don't think we are done with the FII selling yet. But whenever it gets done, it is reasonable to expect a bounce in the Indian markets as well.
Yeah. Actually, Neelkanth, can you put that into perspective, and then I'll come to earnings back again. How important would this narrative about FI's overall ownership of Indian equities be? Because that's the crutch on which people say, okay, yahan se things will turn on the FI side because it's already at a decadal low or whatever year lows, etc., and stuff like that. And how low can it get, etc., etc. And we are at cyclical lows, if not multi-year lows. How important is that statistic? Can it go much lower than what it might be as well?
Yeah, see, the FII ownership of India was rising steadily after 2003-04, right? So it went off BSE 500, the ownership rose dramatically, I think about 4-5% to 22-23% at the peak. I think there's a technical limit on where it kind of bottoms out, right? I mean, I think what matters is, are EMs as an asset class going to get inflows? Remember that only 10-15% of FII ownership in India is through India dedicated funds. Very large part comes through EM funds, some through Asia funds, some through global funds. And therefore, if EMs or Asia are looking slightly less attractive because US 10-year rates are up, or the expectations of Fed rate cuts are being pushed out, and therefore the likelihood that, say, Indonesia or Malaysia also will not have that much room to cut rates, And in general, if you're getting 4.5% on US government bonds, then why take the risk of going to emerging markets? Now, those concerns and questions are still very much alive, and therefore the long monologue I had on why US rates become so important. If the uncertainty on US rates remains elevated and the US rates are not going to really come off, then unless there is a massive positive growth surprise from one of the large EMs, it's very unlikely that EMs will start getting inflows. And which is why, if you actually see them as percentage of market cap, remember that $10 billion in a month seems like a lot of money, which it is. But compared to the percentage of market cap, this is not that exceptional. So a month of 0.2% of market cap selling by FIIs has happened several times in the last decade itself. And the last few times it happened, actually the market declined a lot more because the domestics weren't buying, or the domestic didn't have that kind of heft. But what you should see, because if you look at 3-month or 12-month flows, they are completely unexceptional in the sense that they're not at levels where you see a technical rebound. Generally, if you plot say a 15-year history of 12-month flows as a percentage of market cap, the current situation is very unexceptional. So I wouldn't be surprised if the FII selling, which has continued through November, lasts through all of November. So there is no technical limit on what their ownership level is. I don't think anyone is looking at those. I would rather look at the flows as a percentage of market cap, where they've kind of bottomed out in the past, or when the US fiscal clarity comes and say the US government, the new US government gives some signals on what their actual fiscal plans are and what level of deficits are they okay with. Frankly, given all the other political issues that matter to them on tariffs, on immigration, on the promising of tax cuts that are very important poll promises, it is very unlikely that fiscal deficits or clarity on that is going to emerge. So therefore, 10-year bond yields are not going to come off. So EM outflows and therefore India outflows can last for another several weeks.
Can last for several weeks, viewers. Keep that at the back of your mind when you're looking at the markets too. Now, just a chart that we've gotten for you, because I said that we'll come back to earnings, and I would want Neelkanth's view here. This is sector-wise revision in FY25 earnings estimates for the 200 companies since March 2024. And this blue tag is the profit change since March end. And as you can see, in communication services or some other sectors, maybe those numbers have looked okay, but otherwise, a clutch of spaces, the gashes have been fairly steep, including IT, energy, materials, etc., all looking slightly wobbly on the earnings revision front. Neelkanth, IT services, everybody mentioned that once the November election is out of the way, companies out there might have clarity, and therefore they might be able to take better decisions in outsourcing work to Indian companies. Now that that's out of the way, and we're probably still seeing a rate which is higher for longer, or definitely not a series of rate cuts from the US, never mind what's happened in the FOMC recently. What's your sense about what happens to tech as a space? I'm moving gears now.
Yeah, so tech as a space, see, my only discomfort with the sector is its valuation. So all that you are saying, and I think those are all facts, that tech, is a very low volatility sector. So if it doesn't grow at 8% and grow at 4%, maybe 4 will go to 2. But there is a certain certainty. It's very unlike, say, metals or oil or any other commodity sectors where things can be quite volatile. Secondly, it is very low capital intensity, generates a lot of cash flow, is generally professionally managed. If they're sitting on surplus cash, they're very happy doling it out. They don't want to retain it and make some stupid acquisitions. So they're generally very, very disciplined with capital allocation as well. So it's a good sector. The challenge I see is that it is very expensive. So therefore, a lot of what you're saying, in fact, the lack of clarity, or rather the reduction in the lack of clarity, all of those things will happen. But remember that there are other levels of uncertainty that people are going through. If large tech firms are publicly saying that AI is generating 25% of their code, it is, I mean, there are strategic uncertainties emerging. And while I think Indian firms have gone through significant challenges in the past 25 years, from Y2K to .com, the bust, the transition to mobile, the transition to cloud, and every time they have ended up gaining from them, right? So I'm quite confident that over time, I think the Indian IT firms will also learn how to cope with AI. Now, but will this mean that the productivity per employee goes up dramatically, that their margins improve, but their top line does not? Which companies will be able to make that transition? Do we have clarity on which company has what kind of business exposure? I think all of those uncertainties make me very uncomfortable with the level, the price to earnings multiples that exist. And sequentially, unless the US economy starts to improve a lot, I doubt that we are going to see a sharp rebound in the revenue expectations for these companies. So we are underweight on them. This call hasn't worked because the market was in the last 4-5 months trying to chase. In fact, before the result season, I mean, after that it's worked nicely. But between May and September, as domestic high-frequency indicators were weakening, the markets were trying to get into defensive sectors. So staples, IT outperformed. But that was just, I think, people trying to hide. I don't think there's any significant fundamental improvement that is likely.
Okay, well, the other one which has taken a major hit, and you can just stay on because I want to get in my colleague Mahima to talk about what's gone wrong with Asian Paints. I think a lot of people know, but Mahima tracks this very closely. Mahima, take us through this.
Right. So, Niraj, couple of things that are not working for Asian Paints. They've missed estimates on all front. In terms of the gap between estimates and the actual numbers, revenue is a miss by 6%, EBITDA is a miss by 21%, margins is a miss by 280 basis points, and net profits, excluding the one-off exceptional loss, is a miss by around 18.6%. Now, what has led to this weakness? Demand remains subdued overall for the paint industry as well as for Asian Paints. There has been low product mix, and price inflation has affected the margins overall, and margins are lowest since the past 8 quarters now, and there is headwinds in the international business which is also impacting the overall top line and bottom line. Now, is Grasim putting pressure on Asian Paints or a dent on Asian Paints? CLSA believes that competition intensity continues to increase with Birla Opus increasing its footprints, and it believes that Asian Paints might take further rebates which are likely to increase going forward on the back of Birla Opus giving intense competition. Now, what are brokerages overall saying about Asian Paints? Nomura maintains a neutral and lowers its target price to 2,500 from 2,850, and it has cut FY25 to FY27 estimates, EPS estimates by 13%, and it forecasts an EPS CAGR of 12% over FY25 to 27. Jefferies has maintained high conviction underperform with a target price of 2,100, and it remains concerned on competition. And lastly, CLSA has again reiterated underperform with a target price of 2,290. So all of these brokerages are bearish on Asian Paints. And overall, this is what has overall panned out for Asian Paints in Q2.
Thanks, Mahima, for that. Neelkanth, classic case, well, multiples come off and come off more. Growth now taking a hit as well. What is going wrong here? Is it urban demand? Is it a sector facing idiosyncratic issues? Or is it a combination of a lot of things?
Yeah, I'm not allowed to comment on specific
No, I didn't want to talk on
yeah.
Asian Paints. No.
Yeah,
I'm talking about the paint sector.
Yeah, so what happens occasionally is that because see, one of the big challenges for Indian corporates today is that they need to find investment options. So one of the very important macroeconomic trends that has emerged is that our current account deficit is now maybe 1% or less than that. This is when general government deficit is 7 to 8%, maybe 7.5%, 8%. And household savings are still kind of continuing, but even though on a net basis they may be slightly lower. Now, in this case, who is the beneficiary? I mean, who is getting more savings? And it is the corporates, because there are 3 entities, like government, corporate, households. And the government is net saving, households are not saving that much, and the overall this saving is only very small, which means that corporates are saving a lot. And that you can see in the data. So the BSE 200, the operating cash flows have grown at like 22% CAGR between FY19 and 24. Investing cash flows, which are also growing, so we remain convinced that the investment cycle will remain positive, and we should see some good momentum pick up in 6-9 months. The investing cash flows as a percentage of operating cash flows, which was 140% in 2012 and 14, has now fallen to 70%. So all of these groups now need to figure out where to invest. And some of them could be, diversifying into jewelry. Some could be diversifying into paint. Some are, diversifying abroad, and some are, buying stakes in auto companies. So you will see this phase of diversification, and therefore the competitive intensity in some of these sectors is actually going to change, because you are going to see new companies coming in and new competitive realignment happening, and that uncertainty means lower price to earnings. So those are also challenges that investors should be wary of.
Okay, and Neelkanth, does urban demand? Do you see a step down, slowdown in urban demand, or is it temporary because the government spend hasn't happened, and if the government spend were to pick up, as you said, maybe Jan, Feb, etc., so on and so forth, then things could improve?
That is my expectation.
That is your expectation.
If you think about macro issues which are fiscal and monetary, it is almost like those oxygen bubbles that keep happening in fish tanks, where power goes off and those bubbles slow down. The fish starts swimming slowly, and because oxygen levels are starting to deplete, and then power comes back, those bubbles restart, oxygen is back, and so many of these macro changes that occur when you see an unintended fiscal contraction, an unintended monetary tightening on the quantitative side. It's very hard to explain one-on-one as to what's really happening, but it's all a macro phenomenon. And the moment the flows start showing up, I would say that incrementally the slowdown is not worsening, because see, from May onwards, it was very clear that things were slowing down, and the momentum was very negative. Now I think at the margin things may actually be bottoming out. It's too early to say. There are only a few indicators which suggest that, but we are tracking them, and it is reasonable to expect that as fiscal monetary tightening ends and some relaxation starts, that demand will go up. Now that demand could show up in real estate demand, that could show up in demand for cars, it could demand for consumption items, investment items. So I think all of those are just outcomes. I mean, they're not really input variables.
Got it. Neelkanth Mishra, always a pleasure talking to you. No different today. Thanks for putting all of that into perspective.